Hi, everybody. Welcome to Friday's Focus on Finances. My name is Jamie Fleming, and today I'm going to talk about 14 reasons to set up a self-employed defined benefit plan. If you are self-employed, a defined benefit plan is a powerful tool. In fact, for the right business owner, there's no other financial tool quite like it. So let's go through the 14 reasons why you should consider setting up a self-employed defined benefit plan in 2021. So the first is that self-employed defined benefit plans allow large tax deductible contributions. If you're self-employed, defined benefit plan significantly reduces your taxes while you save for your own retirement. And although other retirement vehicles also allow this, defined benefit plans have contribution limits that are significantly higher than other retirement options. For an example, an IRA only permits an annual deduction of $7,000 if you're over the age of 50, and a SEP IRA limits deductions to $58,000 per year. In contrast, someone who is self-employed may contribute $100,000 to $250,000 plus per year in a defined benefit plan. In addition, in a defined benefit plan, business owners may be able to adjust contribution amounts each year depending on their situation, including business cash flow and taxable income. So it's interesting for a lot of business owners, the thought is that they're stuck in this mandatory contribution, which there are mandatory contributions, but there is a range. So as long as the contribution falls within a contribution range, which can be quite wide, it is permitted to make flexible contributions. Obviously, business owners want contribution flexibility. Often the self-employed use this flexibility to take advantage of higher cash flow or reduce taxation when income is higher. In that case, the business owner may make larger defined benefit contributions to decrease income tax. Commonly, the self-employed may adopt a plan in a very strong year and front load the contribution stream to more closely match tax deductions with expected income. Varying contributions based on business income can be a powerful strategy to minimize taxable income over the duration of the plan. The next reason to consider is contributions grow tax deferred. In addition to allowing significant deductible contributions, defined benefit assets also grow tax deferred. In other words, a business owner is not taxed each year on investment gains. Instead, funds are not taxed until distribution from the plan. So why does tax deferral matter? Simply put, taxation chomps away at your retirement, resulting in less assets to invest and smaller savings at retirement. On the other hand, tax deferral keeps all the assets in the plan, leading to larger asset base, higher investment returns, and substantially more savings at retirement. Over time, the difference actually can be staggering. What's more, when a business owner couples tax deferral with the large contributions permitted in a defined benefit plan, he or she can amass significant assets in just a few years. The next reason is that you can roll over defined benefits at retirement. Upon retirement or termination of the plan, the business owner may receive defined benefit assets in a single sum distribution, which then can be rolled over into an IRA for continued tax deferral. Taxation occurs only when the retiree takes distributions from the IRA. What's the result of continued tax deferral after retirement, you might ask? In short, retirement funds last longer, much longer actually, and alternatively, deferred taxation can allow for a higher retirement income for the retired business owner. The next reason to consider is you can add a 401k plan for additional tax savings. For someone who is self-employed, defined benefit plans allow for massive contributions. But what if a defined benefit plan isn't enough? Is there a way for a business owner to contribute even more? And the answer to that is yes. You can actually pair a defined benefit plan with a 401k profit sharing plan to further increase deductible contributions. In fact, by adding a 401k profit sharing plan, the business owner could actually contribute an additional $43,400 plus per year, may be possible depending on income. The next reason to consider, self-employed spouses can further increase tax deduction. This is huge, and we do this quite often with our business owners. Outside of large deductible contributions for the business owner themselves, contributions may be increased and potentially doubled if the business owner's spouse is an employee. Of course, the spouse's deductible contribution will depend on a variety of factors, but the potential to increase and even double an already large deductible is so powerful here. For a business owner and a spousal employee near retirement, total defined benefit and 401k contributions could be as high as $900,000 plus if the contributions are front loaded to the plan. The next reason to consider, the defined benefit plans are not subject to the 25% compensation limit. Unlike SEPs or 401k plans, employer contributions in defined benefit plans are not limited to 25% of compensation. Since this limit does not apply to defined benefit plans, a much larger contribution is possible for a given level of compensation, providing more flexibility than other retirement vehicles. In fact, it's not uncommon for defined benefit contributions to significantly exceed 25% of compensation. This can be especially helpful when the business owner wants to contribute a high proportion of his or her income to the defined benefit. This often occurs when the business income is not needed for living expenses, such as when there's another source of income. For example, you have taxable accounts, spousal income, or the business is a side business. In such a case, the business owner may want to save most of the business income to this plan. And in most instances, this is not possible with other retirement plans. On the other hand, a business owner is able to contribute a large proportion of earned income to a defined benefit plan. The next reason to consider, self-employed defined benefit plans may reduce your payroll taxes. As mentioned, the 25% compensation limit doesn't apply to defined benefit plans like it does for SEPs and 401k plans. This flexibility allows for payment of lower reasonable wages to achieve a given contribution objective. Since payroll taxes are a function of wages paid, a lower salary results in lower payroll taxes. In this case, defined benefit plans not only provide substantially higher income tax savings than other retirement vehicles, they also may result in lower payroll taxes as well. Number 8 is, if you're in a situation where you haven't saved the way you should, and maybe you're an older business owner, you may have a shorter time horizon. This will allow you to make up for lost time. Defined benefit plans allow for massive contributions, particularly for the self-employed person who is nearing retirement age. And this is because regardless of their current age, a business owner can fund towards an age 62 balance of $2.9 million in only 10 years. This is a huge benefit to those folks who waited a little longer than maybe they should have to contribute to their retirement. This allows for a massive amount of funds to go in and not only get a business deduction, but save for your own retirement as well. So funding to such a large balance in a short period of time is an opportunity not permitted in other retirement arrangements. For example, 401k plans only permit small catch-up contributions of $6,500 per year over the standard contribution limit. However, defined benefit plans allow a business owner to quickly make up for lost time. Specifically, deductible contributions are permitted such that an age 62 balance of $2.9 million can be accumulated in just 10 years. For someone who is 50 years old, this can mean annual contributions of approximately $250,000 per year for 10 years. If the owner's spouse also is an employee, the permissible contribution could potentially be double here. And let's say the opposite is true. Let's say you have a longer time horizon. You can contribute more for compounded growth. Younger self-employed individuals can also benefit from a defined benefit plan. For example, even for business owners in their 30s, defined benefit plans allow for deductible contributions in excess of other retirement vehicles. Specifically, for example, a 35-year-old may be able to save $100,000 plus per year. This amount is further increased if the spouse is also an employee and by adding an additional 401k plan. By making large contributions sooner, the younger business owner has a long period for returns to compound. This is an advantage because it significantly reduces the cost of funding for retirement. The next reason is cash balance plans look and feel like 401k plans. Defined benefit plans can be complex. For example, traditionally, defined benefits were expressed as a monthly annuity. Upon distribution, this monthly payment stream then would be converted to a lump sum payment. Under this structure, it's not difficult to see why business owners did not know the value of their benefit. However, in recent years, cash balance defined benefit plans have helped simplify the defined benefit plan concept. This is because cash balance plans are expressed as an account balance rather than a monthly annuity. The value of the benefit is simply the account balance. A conversion from a monthly annuity to a single sum is not required in this example. So how do cash balance plans work? At a high level, each year, the employer provides a predefined pay credit, which is added to the existing account balance. Additionally, the account balance is increased each year at a predefined rate of interest. Pay credits continue each year with accumulation at the predefined interest rate. When the business owner retires, the cash balance account is simply paid out in a single sum. This amount can then be rolled over into an IRA to avoid paying taxes all at once. The next reason to consider is defined benefits create employee engagement and retention. So let's say you are self-employed, but you do also have employees. If you had to choose between paying $1,000 to the IRS in the form of income taxes or giving $1,000 to employees in the form of benefits, which would you choose? Since a defined benefit plan generally must cover a portion of employees, business owners are essentially making this decision when choosing to adopt a defined benefit plan. If a plan is not adopted, the owner will pay higher income tax. If a plan is adopted, the owner may need to give employees a benefit, but this can be a wash. So where do you want the money to go? Who will it benefit the most? Everything else being equal, providing higher employee benefits is much more beneficial than paying higher income taxes. Think about it. Paying unnecessary taxes does not provide any benefit to the business owner. On the other hand, funding employee retirement benefits would likely increase employee appreciation, engagement, and retention, leading to stronger profitability and growth. What's more, usually the taxes saved under a defined benefit plan are significantly higher than the cost of the required employee benefits. This further supports the decision to adopt a defined benefit plan in the right circumstances, even when a business owner has non-owner employees. The next thing to consider is that owners receive the lion's share of the defined benefit assets. Although employee benefits may be required in the right circumstances, it's possible to allocate 80 to 95% of the employer contributions to the owner. In situations like this, the cost of employee benefits is more than paid for through reduced income taxes, providing a net savings to the business owner. How much the owner receives as a proportion of employer dollars will depend on the age and earned income of the owner, whether the owner's spouse is also an employee, the number of employees, and the ages and compensation of the staff. So if you want to make a large deductible contribution but have employees, we can run an illustration to quantify the possible tax deduction and the corresponding cost of providing staff benefits. This information can help you decide if a defined benefit plan will be cost effective for your particular business. The next reason to consider is the loan option is available in self-employed defined benefit plans. To the self-employed, cash is king, and the ability to access cash at the right time may mean the difference between success and failure. Even business owners with predictable income experience financial pressure when economic conditions deteriorate. As a result, tying up large contributions in a retirement plan can be a concern for many business owners, even when they receive a large tax advantage. So, what is the solution here? Fortunately, defined benefit plans like 401k plans can permit loans. While loan provision in a defined benefit plan has its drawbacks, providing the option can make sense in the right circumstances. And lastly, defined benefits provide creditor protection. Generally speaking, defined benefits are protected from creditors in the event of bankruptcy. The ability for you to shift business assets, which are subject to seizure, to a protected defined benefit asset is a huge advantage here. So you might be asking, should you set up a defined benefit plan? Whether a defined benefit plan is right for you depends on a number of factors. However, if you're self-employed or at least 35 years old and like to save more than $60,000 per year for the next 3 to 5 years, you should strongly consider a defined benefit plan. And if you're curious about how you could deduct the plan from your business assets as a taxable deduction, give us a call and we can give you a quick and free estimate of what's possible in your situation. If you'd like to receive a more in-depth analysis, contact us for a complimentary consultation. This analysis will give you the information needed to make an informed decision. So if you go through the process and you may be thinking, gosh, next week is already November, which is why we're doing this focus on finances in the fourth quarter. We want you to have time to still put things in place for 2021 and get the maximum benefits. So when must you adopt the defined benefit plan? To receive a 2021 tax deduction, you must adopt the defined benefit plan by the time you file your business return. So this could be your normal business return deadline of March 15th, but it also includes extensions, so September 15th. So how to deduct the expenses of the plan: adopt your plan in the current year if you want to deduct the fees to set up the plan. You may also have payroll requirements, and these must be fulfilled by December 31st. So there is some complexities in this plan, but you're not in this alone. So if you have the right team in place, these things can be done, making sure you're hitting the deadlines, getting the maximum contribution. The other thing to remember is that we're talking about getting the maximum benefit of a plan still in 2021. You also have time to fund the plan. So there are different pieces of the puzzle. You have payroll requirements that have to be done by December 31st. There has to be a plan adoption by the time you file your taxes. But more importantly, you have to fund the plan by the time you file your taxes as well. So one thing I have always encouraged, and we set up our business clients to do this, is to make sure that you're not waiting till the end of the year every single year to fund your plan. So we look at putting things in place so that you're taking advantage of high cash flow months, maybe put some funds in the plan. So by the end of the year, you're not having to come up with an incredible amount of money for either taxes or to fund the plan itself. And as an example, we did this for a client who had annual revenue of about $800,000. By the time their corporate taxes were done, they were going to have a personal income tax exposure on $400,000. So for that client, just by simply giving them compensation of $200,000, we were able to set aside over $190,000 into their defined benefit plan and 401k plan combination. In doing this, their tax exposure was reduced by $74,000. So that person now is set up to do this every year for the next several years until retirement. So you want to look at your situation, do some planning, work with a team, and get it done. I hope you enjoyed today's Friday's Focus on Finances, and we'll see you next week. Have a great weekend, everyone.